For many people, the word investing conjures up images of men in suits, monitoring the exchanges of millions of dollars on a stock ticker. But let me tell you that you don't need to be the wolf of Wall Street to start investing. It's okay if you're more a mouse of Main Street. Even if you only have a few dollars to spare, your money would grow with compound interest. The key to build wealth is developing good habits, like regularly putting money away every month. Stop buying the coffee at Starbucks. Instead, make your own coffee at home and you could already be saving more than $50 a month. Once you have a little money to play with, you can start to invest. In this video, I'll show you tips that will help you to find winners, manage your emotions, and keep perspective during uncertain times. Make sure you hit the like button, share this video with family and friends, and subscribe to my channel if you haven't done it yet. Now, let's get started. Before we know it, 2021 will be here, and with any luck, it will bring some good news with it, like an end to the pandemic. But we don't know what 2021 has in store for the stock market, and while investing values could hold steady in the new year, we can't discount the possibility of a stock market crash. In 2020, you can get a date, a ride, or a pizza with the swipe of a smartphone screen. Investing is not different. If you can automate your bills, why not your investments? It's just as easy. Investing comes in many different forms. It shouldn't be a scary word for you. With so many different options, investing for beginners is simpler and more straightforward than ever before. Soon, you'll see how addictive growing your money can be. That's why it's important to prepare for a number of different scenarios in the coming year, and here are some tips for doing just that. Number 1, keep it simple. Investing can be a time-consuming process, but it doesn't have to be like that. If you don't know how to research a stock or are too overwhelmed by the idea, stick to index funds. Index stocks let you buy a bucket of different stocks, and their goal is to match the performance of the market indexes they're associated with. As such, if you were to invest shares of the S&P 500 index fund, you'd effectively be investing in the broad market without having to do any significant amount of legwork. Next, diversify. It's a basic rule of investing that to improve your chance of a better return, you have to accept more risk. A diversified portfolio can help you to protect you in the face of volatility, so your goal should be to load up on stocks from a range of market segments. And if that's too complicated, once gains index funds get a job done, of course, you may want to expand your horizons beyond the world of stocks. Bonds, though more conservative, could be a reasonable addition to your portfolio, as could real estate, whether in the form of physical properties or rates. But you can manage and improve the balance between risk and return by spreading your money across different investment types and sectors whose price don't necessarily move in the same direction. This is called diversifying. It can help you smooth out the returns while still achieving growth and reduce the overall risk in your portfolio. Now let's talk about risk. First of all, you should avoid high-risk products unless you fully understand their specific risk and are happy to take them on. Only consider higher risk products once you build up money in a low and medium risk investments. And some investments are usually best avoided altogether. When you're in the early phase of building wealth, there's a tendency to want to take additional risk to move faster. It's a common human trait, especially in the modern world. We want it all now. However, if you're going to be successful over the long run, you have to manage risk properly. Incurring losses chasing fast returns will derail you faster than anything else. Know your limits and the limits of your investment you're making, and build your expectations around these limits. Next, make sure how your portfolio is performing. Say at least once a year. This will ensure that you keep track of how your investments are performing and adjust your savings as necessary to reach your goals. You will get regular statements to help you do this. However, don't be tempted to act every time prices move in an expected direction. Market rise and falls all the time, and if you're a long-term investor, you can just ride out these fluctuations. Next, don't invest money you need for a living. You will have seen many times the notion of saving a percentage of your wage for investing purposes. It's commonly suggested to put 10% away, and irrespective for the percentage, I highly recommend you pay yourself first and allocate something for investing from every wage payment you receive. The key to this tip, however, is to ensure you don't tie up money in investing that you need to meet your ongoing living expenses. By overcoming money to investments, You create more stress on your daily life, and this will lead you to poor investing decisions and therefore results. Invest what you can afford to, and no more. Also, it's important when you're starting and building your wealth that you invest in assets that you are familiar with. By starting where you are familiar, you build confidence and a skill to move into the other assets as you progress. But don't forget, set a goal and realistic expectations. Decide how much money you want to invest and by when, and calculate what it would take to get there. For example, investing $1,000 and expecting to make $100,000 from it in 5 years could be unreasonable when you first start. I'm not saying it never happens or can happen, but it's not a common or realistic assumption to start with. Knowing these numbers will also help you to understand the type of asset you will need to invest in and the level of risk required to get the returns you need. Since returns are a function of risk, the higher the return required, the higher the risk you will need to take. Knowing this in advance can enable you to adjust your expectations. And remember, you don't have to take on too much risk. One ratio that can help you to know how much return you can expect is the ROI. That means return on investment. So you look the stock that you want to invest and then look at the ROI from the past 10 years. Let's put an example. Let's say you want to buy Apple. Well, currently a share of Apple will cost you $131. It has a market cap of just $2.2 trillion and a PE ratio of 40.29. That means every $40.29 that you invest in Apple, you will receive $1 back. Now let's check the ROI of Apple. Here we can see that Apple has performing very well in the past 10 years. It has good returns that surpass the 10% annually. Knowing these numbers can help you to have the big picture of the company. Also, this will tell you how fast you can have your money back as well. Investing for wealth is a long-term game. It's just reality. Accept it and move on. As I mentioned before, the big gains come from the power of compounding. Be prepared to stay in the game for the long term. You'll learn a lot of things along the way that will make you a smart investor. You will make mistakes, but as you're smarter, you will also learn from those mistakes and do it better next time. By being in the long term, these mistakes will also easier to manage and recover. Now, investing for long run doesn't necessarily mean buy and hold the stock forever. It just means that it's a long-term game and you need to be prepared to play it for the long term. Sometimes you will need to sell stocks that aren't performing well. It's just a part of the game, but never make emotion decisions. Your thoughts lead to your feelings lead to your actions, and your actions lead to your results. Which means we need to be in control of our emotions when making investment decisions. You will develop experience and skill as the time progresses, leading to better decisions and a consistent basis. But when you start out, you won't necessarily have the experience to guide you. Having control of your emotions when making investment decisions will ensure better outcomes. A good example of this problem is what people do when a stock market falls sharply. Most people panic when their stocks are falling and they sell, normally right at the bottom. If you take the emotion out and realize that you're in the stock market for long term, the markets recover. You will save yourself that loss and even be open to the opportunity of making some money when prices start to recover. Investing is something everyone can do and should learn how to do. It's your money and your future we're talking about. Nobody else is going to be concerned about your future like you. Next, invest regularly and consistently. To use compound interest, put money into your investment on a regular basis. It doesn't have to be a large amount of money to make a difference. It also doesn't have to mean putting money into an investment. Do something every day to become a better investor. Do some research, read books, magazines, forums. You can also get some coaching to help you guide you. There you go. All the tips that your investment will need for 2021. These tips will serve you well as you build your financial freedom. As you can see, they aren't complicated, they aren't difficult, and they are simple to implement in your life. Using a combination of these investing tips each day or week will have you celebrating your newfound money and wealth sooner than you thought. If you like this video, let me know in the comments below which one resonates with you the most and how could you use these tips in your investment goals. Subscribe to my channel because every week I'm in YouTube with new content, and do not forget to activate the bell so you don't miss any of our videos. See you next time.